Hello, welcome everyone. My name is Seewing Yee and my co-host is Julie. How are you, Julie?
Hi, good morning, Seewing. How are you?
Fine, thank you. So we want to discuss this because over the years, as I've been consulting many real estate investors, mainly from California, and the challenge that people are facing, there are so many overwhelming strategies out there. There are mainstream media, the real estate gurus out there, the YouTube influencers out there. They're promoting so many different real estate investment strategies that could overwhelm a lot of people, Julie.
Of
And
course.
but when you are presented with so many different options, you lose focus, you lose commitment because you're so overwhelmed. You have this like analysis paralysis. You don't know which strategy to use. You don't know which buy box to ultimately to use and focus on that buy box to buy income properties, whatever, achieve financial freedom. So today we're gonna help you to narrow down the focus so you can find the right box that fit your situation, your goals, your personality, your skill set, and etc.
Right.
Okay. All right. Let's discuss that. So our title will be, what is your ultimate or any quote buy box? You see the box?
I love the photos. Yeah. All the different size boxes. Yeah, that's great.
At the end of this podcast, Julie, I hope many of you, if not most of you, have ultimately defined and conclude what is the best buy box for you. All right. All right. With that said, I'm gonna categorize four different things we could talk about. We could talk about real estate investing, active investment. We could talk about semi-active investment. We talk about semi-passive investment and totally passive real estate investment. All right. This is from a high level. We're not gonna spend hopefully not more than 20 minutes. So
Right. Sure, sure. Mhm.
yeah. So oh no, the YouTube world, most people, those gurus out there, they love to pie in the sky. They're very misleading. They look. It's a matter of is the YouTube world. They want clicks. They want views. They want subscribers. They love to promote real estate investing with excitement and being sexy. Okay. The more excited, the more excitement they present their investment strategies and their most sexy investment. That human brains are very emotional. They get stimulated by sexiness and excitement. But beware, uh, based on our long-term investment strategy, my business model that I've been practicing, and you are also feel the same way. You need to buy boring and not sexy investments. That's how you create generational real estate wealth. Am I right about?
Absolutely. Yeah, I agree with that 100%. Yes. Mhm.
Okay. Okay. We'll dive deeper into it. Okay. We'll validate our philosophy by the end of this. Big, okay. The first category is sexy and exciting. They require a lot of like fix and flip, wholesaling, house hacking, self-managing your own property. Look, a lot of our investors, we live in California. Most of our investors, like yourself and myself, we live in
Right.
California. It's a very high cost market and we cannot buy in our own backyard. So we had to go out of state, hopefully, to buy good properties. But yeah, look, anybody live in California or other high cost markets such as Pacific Northwest, Seattle or Chicago or Northeast, Washington, D.C., Northern Virginia, New York City or Boston or Connecticut, New Jersey, all these high cost market, the numbers does not make sense. So you had to go somewhere else to buy cash flow properties. That makes sense number wise, right? But you run into all these you gurus out there that are misleading you. They try to sell sexy and excitement, self-managing. They want to do, let's do short-term rental, let's do mid-term rental, let's do RV parks. That's 1,000 different ways. Let's do syndications, all this fix and flip. These kind of ongoing active investments take so much of your time. I don't know about you, but most of our investors, we have full-time job. We have a life to live. We have children to take care of. We have a very busy. We have no time to go out of state and do this, fix our own, fix it.
That's
Buy
true.
birth strategy. You buy, Yeah, you rehab, you will refinance, and you repeat the BRR strategy.
Right.
Sounds exciting, but every step of that, those words, see,
Mhm.
there's a huge element of risk on it. The
It's a
BR,
huge element of risk. I agree. It's a lot of learning curve, especially if you've never done it. Now, I know my husband's uncle, he loves that. He's very hands-on, but he's done it for like 60 years. But that's what he does. And it doesn't really have a life outside of that.
I heard that a lot of old school, old investors, they've been doing it for 50, 60 years. They will never change, right? I mean, they buy in their own market, they buy in their own neighborhood, they
Right.
manage, they self-fixing, they are oblivious to evolving real estate technology and what have you.
Right.
They're old school.
Very old school. Yeah.
Yeah, anyway, so that's not part of the scheme, but the future of real estate is very
Most
different.
people can't do that though.
Most people can't do that, and even if they can, they should not do it. Okay, because you're trading time for dollar.
Yeah, absolutely. Absolutely. 100%.
You're supposed to buy the income property for returns, to give you the cash flow, to give you the appreciation, the tax benefit,
Mhm.
so you can focus on what's important to you, right? Focus on what's important to traveling or take care of your loved ones or go do a hobby, whatever. You need to free up time. It's all about freeing up time so we can live off the passive income, right?
Absolutely.
Yeah. Yeah. And doing this active investment, as we discussed, it's just not most people cup of tea. So, and
Feasible for most people.
yep, for most people. Yeah. The other category is one-off active investment. This category has initial upfront work, yeah, but eventually can be turning to over a property management or for longer buy and hold. Yeah, this one might work for some people, even some people live in high cost areas such as California. It's doable.
Right.
We did mention about the BRR strategy, buy, rehab, rent, refinance, repeat. But in
Mhm.
this current volatile housing market, it's very hard to make per strategy works. Okay. I've seen a lot of people got burnt in the past
Mhm.
trying to do the burst strategy on this very volatile mortgage rent rate, interest rate environment,
Right.
and down with the last few years of the skyrocketing home costs and higher rates and everything else. But anyway, but upfront, you have to do a lot of work. If you do it right, long term, it could be more passive, which is have a lot of potential, but
Right.
still, a lot of people, they don't want to do a whole work still. So
Yes, I
still,
get
yeah, it's not the best strategy in my opinion, but yeah, it might work for some people. Okay. And the third category is semi-passive investments. Okay, let's go over this. With
Mhm.
the team and systems, you know how hard it is to find the right team and systems, but
Right.
my network have the right team and systems, right?
Absolutely.
Because you used one of my right team and the right system in Buffalo, Niagara Falls, New York.
Oh, yeah.
You bought it remotely, passively, long distance, turnkey, sight unseen to my great team in Buffalo, Niagara Falls, to the tune of 6 rental properties in your personal portfolio. No partnering, 100% your
Right.
name and your husband's name and
Mhm.
in the name of the IRA, right?
Absolutely. 100%. Yeah.
However,
Mhm.
yeah, we don't, that's how, now how we describe our investment methodology as semi-passive. I still do not consider our investment model and what you
Right.
have done with your portfolio is
Mhm.
not semi-passive. We'll get to that momentarily. But semi-passive, in a traditional definition, it means either purchase an asset directly or on a JV partnership. I do not like partnership. You retain the day-to-day operational power, which can be good when things are run smoothly, but it can also be challenging when you have a sudden or ongoing
Right.
issues. All in all, these options require periodic oversight, but tend to be less demanding than active strategies. Again, semi-passive, I still do not like this system. Okay.
Mhm.
So do you have any thoughts on this particular category of investing? Semi
I think the last point you made about if there's sudden changes that can complicate things, sudden or ongoing issues, it can be a complicated. It's obviously a little bit better than the previous two, but it does still have its challenges.
yeah. And the final one, which this traditional technical definition of passive investment still does not take into consideration of what we do, our business model. I believe our business model is almost 100% passive investment, almost in this category. But I'll describe it momentarily. But let's go through the traditional definition of a passive investment, which is a true passive investment is where you are investing your capital and a professional team is managing the entire investment. These types of investments require minimal ongoing effort and include options like raw land, performing note funds, private real estate syndications, and crowdfunding platforms. These investments allow you to enjoy your time, attention, and steady returns with limited active involvement. One thing, in my opinion, and you, I'm sure you agree, what this definition is lacking is that they should include passive investing into our business model, which is buying turnkey, new construction, mostly remote, long distance cash flow properties in the growth markets where you can maybe spend 1 or 2 hours per month.
Right.
Your portfolio
Definitely.
of a single family home, duplex and fourplex, new construction in a good growth market in South and Southeast and some in the Midwest. This is our definition of passive investment. But before we
Right.
further, another form of passive investment are like real estate investment trust, REIT,
Yeah.
or syndication. A syndication, you rely on a general partner. You rely on a syndicator to do all the work for you, whether the syndication make money or not. If a syndication lose money, the general partners, the syndicator, the running the show, they still make their fees. They still charge you
Absolutely.
fees. Whether you make or lose money, at the end of the day, you may lose the money on this syndication
Right.
where you and thousand investors pooling your money together to do a syndication, which is by definition very high risk. And another form of passive investments could be like stock market stocks, stock market mutual funds, stocks and bonds, treasury, just pure paper money, CDs, money market, mutual funds, individual stock. These are pretty much passive investing. However, on historical basis, stock market, pure passive investment, where the investor does nothing because it's low risk, the return is low on a historical basis. When you talk about 100% passive investment, right?
Absolutely. Yes, I
Yeah.
agree with that 100%.
When you invest in a strategy where there's a little bit element of active involvement, but presumably a little bit more inherent risk, it's still that's the ideal world. Okay. And that's the world that we practice in. So before I will go through the details of what we describe our investment, our business model as a almost true passive investment. Do you have any final thoughts on the pure definition of 100% passive investments and pros and cons? What are your and any further
Well,
thoughts?
again, I would go with what you said. I think what we do with the turnkey, or how you have taught us how to use the different, what do you call it, support systems in place, the interest and then the Buffalo turnkey and all the different people. Once you get the property in place, literally your job is done. So I would say if it's not 100% passive, but I put it up there about 98%.
It's good enough in my book.
Exactly. Exactly. Yeah.
Yep. Yep. And so with that in mind, so here's the recap from the previous presentation. So ultimately, look, those active risk investment, fix and flip, short-term rental, mid-term rental, and self-managing, all those active, passive, hybrid kind of strategies, you and I do not go for that. But before we will dive deeper into our unique methodology, at the end of the day, down the road, all these type of strategy we discussed are not sustainable. Yeah, all those young folks out there in the age 20s, age 30s, they have a whole bunch of time on their hands. They want to get involved physically, hammer down, rehab the property themselves, self-managing because they enjoy it because they are young. They want to be aggressive with their investment. They might want to do this active investment methodology, right?
Mhm.
However,
Absolutely.
you and I been there, done that. We went to the school of hard knocks. Okay. And here's my belief. For most investors, the goal is to eventually shift away from those constant hands-on involvement and explore more passive options that require less day-to-day management while still generating solid returns. By doing so, you can achieve a better work-life balance and focus on other aspects of life that matter to you. This,
Exactly.
amen. This is so
It's
important.
quality of life. It's quality of life. And again, as you approach closer to retirement age, how much time do you really want to spend managing properties, collecting rents, fixing toilets in the middle, leaky toilets in the middle of the night? Nobody wants to do that. The whole idea of having passive income is so you can maintain or improve your lifestyle so that you can do the things that you want to do.
I agree, absolutely. So with that in mind, so let's dive deeper what we mean by that. This is the what we practice. This is our strategy. Almost 100% passive, like you said, is 98% passive. Okay, that's good enough. Our blueprint is buy new construction in better locations because you're getting a higher quality tenant stay 2 or 3 years at a time. Very
Mhm.
low maintenance, very low capital expenditures, very low vacancies, not in a flood zone, away
Right.
from in areas, no condos that have underlying HOAs, no. And by new construction, you still have very low insurance costs, knowing the insurance has been rising in many housing markets. Buy in South and Southeast, where some of those locations have no state income tax. You buy in a market where it's a landlord friendly state, which is good. And you buy those new construction at entry level homes you can cash flow with 25% down payment. Emerging markets, path of growth, low affordability, entry level homes, where a lot of migration of people going there,
Mhm.
brand new homes, brand new infrastructure, brand new hotels, brand new warehouse, brand new high tech companies moving in, brand new hospitals, brand new universities. Those amazing economic drivers that you need to look into. So that is what I call blueprint. And
Mhm.
result, we only have 5 minutes, Julie.
Nice, nice product. Oh, that's a nice house.
And the submarkets, not just Florida and Texas, the submarkets in Oklahoma, in Arkansas, in Alabama, and parts of Tennessee, they are also part of our new construction business model, which we just discussed. And for example, in Oklahoma, you can buy a brand new entry level single family home, brand new for
Right.
150K. Oh my goodness. Is
Mhm.
it true? It is true.
That's a
Okay.
great property. New
Yeah.
construction.
Yeah. So
Can't beat that.
I'm not going to go into detail. We have done other videos, you and I, to talk about this specific market, but this is high level, Julie. Amazing. Nowhere else in the country you can find anything brand new from a regional builder in a fast growing area such as in Oklahoma, Lawton. So still cash flow, even a 20% down payment, you can still cash flow. So this is just one example. Another example in Florida, Central Florida, you can still buy a new construction single family home for only 264 for God's sake. Oh my
Wow.
God. And the building will give you some incentives to give you
Oh my goodness. Interest rate below
yeah,
5%.
yeah, the builder will give you they can buy down the rate for you with none of it out of your pocket. They can with 0 points out of your pocket, they can so you have a lower fixed rate mortgage, so you can cash flow more, at least $300 or more, which is
Mhm.
amazing value. This incentive is going to go away, I believe, by next year because the market is being robust again. The mortgage rates keep falling. Right now, it's like almost 6% as we speak.
Mhm.
Today, September, today is in the middle of September 2024. And who
Mhm.
knows, like, the mortgage rate will fall below 6% in the next few months. And beginning with the spring 2025 season, the floodgate is going to open. The people going to get off the sidelines. You have more
Right.
competition, multiple offers. Housing prices will go up, and no more incentives, no more this kind of incentive. By the way,
Right.
2 years property management fee. The first 2 years. I mean,
Wow.
this is amazing. So right now is a great time to pull the trigger because you don't
Mhm.
have that much competition. So this is crazy. This kind of opportunity is a once in a lifetime. So take
Yeah.
advantage. Yeah, and
Mhm.
thing duplex in South Florida is under 400K.
I know.
Like in a fast growing area in Ocala, this is mind boggling. All the numbers, great cash flow. And of course, in South Texas and Central Texas, we promote a lot of new construction. 1% rule. Who ever heard of 1% rule? New construction in the growth market, which is insane, by a fourplex for 500K price range. Very fast moving market, very high cash flow. The
Wow,
whole,
that's
yeah. Once again, as you and I know, we surrounded ourselves with a credible team that does everything for us. Property manager, pre-screen the tenant, pick the tenant, find the tenant, do everything for us. Us out-of-state investors, we almost do nothing. The,
great. Great.
the only time, Julie, not only you, but hundreds of investors I've helped over the years using our methodology. Not only you, whether you own one out-of-state rental or 10 or 20,
Mhm.
you spend 1 to 2 hours per month
That's
in,
real.
in managing your real estate portfolio. What now? Please elaborate. Those 1 to 2 hours per month, what does it typically consist of? Go ahead.
Oh my gosh. So usually I do mine once a month when we get the rent in because they'll send statements based on the different properties that we have. I input the system into our property tracker software, which keeps track of it. And the reason I need to do that is because at the end of the year, you can pull all that information off at the snap of a button and send it to your tax account. So that helps us keep track, helps them when they do our taxes, helps us keep track of if we're being profitable or not. But it really is so simple. And like I said, I've gotten it down to a science. I can do it in less than an hour.
So, Julie, what I hear you saying is not only you, but all the other investors in your position using our business model that we use
Right.
within the network is that your 1 to 2 hours, if I hear correctly, correct me if I'm wrong, the time you spent is looking to the login portal property. The
Right.
login portal is you put in your login password, the property management, do all the activities. You just take a look at it. Okay,
Right.
just what's happening. You
Yep.
don't you don't need to call property manager. Oh, what's going on? No, the login portal, the technology will document everything on a daily, weekly, monthly basis. And furthermore, you spend a lot of time if you have 5, 6, 7, 8 rental properties. Richard at Benny, my loan agent, he has more than 20 rental property, and,
Wow.
and we did
Nice.
a short video. And he said most of his time spending 1 to 2 hours per month is collecting the checks.
Sure. Perfect. I love it. Love it. That's real. That's
That's
real.
it. We
Uh-huh.
don't anything else. We don't evict the tenant. We do not pre-screen the tenant. We don't do any
Yeah.
kind of hammer, rehab, fix the house. We buy an investment property for the return, the yield, the cash flow, the passive income, the appreciation. For the we look at the paper, the return. That's really, we are an investor. We are not a landlord. The traditional definition of landlord is you buy the property next door to where you live and you fix up the property. You you find the tenant yourself. You self manage the property yourself. You do all the dirty hard work for years and years to come. That's a traditional definition of landlord. You and I, we're not landlord.
That's correct. It's an investor. And it really, if you think of it, it's a different mindset. Like you said, the landlord is very hands on, but it does limit location for you. Because, like you said, you have to really buy it in your own backyard because you can't buy something in a state 2,000 miles away because you can't self manage it. So, yeah, so being an investor is a completely different mindset. It's just like if you invested in the stock market. You're going to tell your broker what you want to buy, and then he's going to manage it, and you don't do anything with it. So ours is very similar. Once we get the property, we instruct the property manager on how we want it to be handled, and they do all the rest. And then they just send us the rent check every month.
That's it. That concludes our presentation. You summarize everything. What is there to summarize? This the
Right.
future of investing. The future of investing, in my opinion, is what you just said. I don't need to repeat any word what you just said. You just recap it. You just summarize it in such a great way. This is the
Right.
future of real estate investing moving toward the rest of this century.
100%. I agree with that 100%.
That said, as we conclude this podcast, if you see any value whatsoever, please like and subscribe to our YouTube channel, and also comment below about what you think about our strategy. And also put your email into our website below in the newsletter inbox. Put your email so you become a free member of our real estate network. Every morning you'll receive email directly into your email inbox, free information so you can learn more about real estate investing and additional investment opportunity you can take advantage of as well. Thank you so much.
Thank you.
Thank you, Julie, for attending. I'll see you guys next week. Same bat time, same bat channel.
Sound good.
Bye-bye.
Thank you. Bye-bye.